If you thought the NASDAQ took a beating this month, wait until you get a load of the 3 ridiculously cheap dividend stocks we're talking about in today's video. Each of these stocks saw double-digit losses in the last 30 days, and from what I can see, they all look like pretty affordable buys as we head into November. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios. And also leave me a comment below and let me know which dividend stocks you have your eye on. I'd be curious to hear what you think is looking good. Speaking of looking good, the first dividend stock we're talking about today is Lam Research Corporation, ticker symbol LRCX, who manufactures semiconductor processing equipment, and companies like Intel, Micron, Samsung, and Taiwan Semiconductors use equipment from Lam Research. And despite their impressive roster of customers, LRCX is still plummeting in share price. Just this year, they are down 51.12%, and in the last 30 days, guys, they are down 12.23%. Which begs the question, what in the world is making this stock drop so much in share price? And from what I can tell, guys, there are a couple things happening here. The first of which is just that really the entire stock market is going down. In the last month, the Dow Jones has seen a drop of about 0.8%. The S&P's drop is a little bit larger. They're down 4.63%. And just in the last 30 days, the NASDAQ is down right around 7%. So Lam Research is not alone in this negative share price performance, guys. As many of you know, there are a lot of stocks that are really coming down in share price, which is great for us dividend investors. But the next thing that's really been taking the win out of this stock sales is that the semiconductor industry has just been taking a hit. And this snippet from an Azo Materials article explains it pretty well. In 2021, global chip shortages became so bad that it shut down automotive production lines. The continued global semiconductor chip shortage was worsened by the disruption caused by the COVID-19 pandemic and continues to affect industries that are reliant on chip technology. Automotive and technology manufacturers have felt the biggest strain, although all related industries have been impacted. The chip shortage is predicted to linger for many years given the steadily increasing demand for this technology. Companies reliant on chip technology will need to become more agile in their strategies to survive this. Now, while this isn't the best news in the short term, the semiconductor industry in time will get back on its feet. It's a very important industry, and Lam Research will be no exception to that. The article here goes on to say, in the coming years, the global semiconductor market will also likely undergo significant changes in terms of the companies that have the most influence over the space. Tech giants like Apple, Google, and Amazon have plans to produce their own chips, overcoming the challenge of the chip shortage and differentiating themselves from the competition. This changing competitive landscape will have an impact on the technology available to the wider market and will therefore influence the direction in which applications of semiconductor technology develop. But this could be good for Lam Research. They could potentially pick up some new customers from this. If there's more people looking to make their own chips, Lam Research is selling the equipment to make that happen. At any rate, the combination of these things has just sent the stock share price southbound, even despite their rosy earnings where they reported a beat on earnings per share, which is great, a beat on revenue as well, which is fantastic. And expanding on this, the company's CEO Tim Archer says Lam exceeded $5 billion in revenue in the September quarter, an all-time record. Solid execution combined with easing supply chain conditions produced strong overall performance. While we expect weaker wafer fabrication equipment spending in 2023, our technology leadership and demonstrated track record of managing through downturns provide us a strong foundation to capture the exciting opportunities ahead for the semiconductor industry. Lam Research continues to outperform, and it sounds like there's some good things ahead for this company. Now, switching gears and talking about their valuation, they have a single-digit PE ratio, 9.77, which is about 40% lower than the sector median, and also is about 40% lower than the company's 5-year average PE ratio. And if we scroll down a little bit, taking a look at the price to cash flow, this is also in the single digits, near 50% lower than the sector median, and also near 50% lower than the 5-year average. Both numbers are looking fantastic, which does indicate some sort of discount both compared to other stocks within the sector, also compared to this stock on a historical basis. Now, talking about the dividend stats, now the forward yield is nothing out of this world, 2.09%, very average, but guys, take a look at this 5-year growth rate, okay? That's just knocking my socks off. I'm not even wearing socks right now, guys, but if I was, they would be far across the room at this point. And the dividend growth history is not too shabby, 7 consecutive years of dividend growth. And if we go over the dividend history page right here, we can see that that's the same amount of years that they've been just consistently paying the dividend. All right, now moving on to stock number 2. This one's also in the semiconductor space. We have Skyworks Solutions, ticker symbol SWKS, whose products help devices that we use every day like cars, Wi-Fi routers, phones, tablets, and the like connect to 5G, Wi-Fi, and Bluetooth. So very important. Year to date, guys, Skyworks Solution, just like Lam Research, is taking a big hit in share price. This is like a ski slope right here, guys. Year to date, they're down nearly 50%, and in the last month, in the last 30 days, they're down a whopping 17.5%. Huge drops all around. And if we zoom out across a 5-year period of time, this officially puts Skyworks Solutions in the red across the 5-year period. And look at this, guys. At its highest, it was about $115, $16 per share higher than where the share price is sitting today. So definitely a big discount on Skyworks Solutions right now, which once again begs the question, why is this stock down so much? And as I'm sure you can imagine, being in the semiconductor space, like Lam Research, there's a lot of the same issues going on here. And in addition to the broad market decline and the general weakness in the semiconductor industry, one article I found on Seeking Alpha also adds weakness in PC demand as one of the catalysts. But at any rate, it's got the valuation looking rock solid right now, guys. The PE ratio is even lower than what we saw with Lam Research, currently sitting at 7.36, which is about 56% lower than the sector median PE ratio and is just over 50% lower than the company's 5-year average PE ratio. And the dividend stats are looking pretty great too. They have a starting yield of 3.04%, not too bad, with a very low and a very comfortable payout ratio of 20.68%. And look at this 5-year growth rate, guys. Once again, this is stupendous. And I've never said that word before, stupendous, but guys, I don't know how else to describe this. 15.5% for the 5-year growth rate with 6 years of consecutive dividend growth. And now moving on to stock number 3, guys, this is one that we absolutely had to talk about. It's Ally Financial, ticker symbol ALLY, which is an online bank, strictly online. They don't have any physical locations, and they also have one of the highest interest rates on a savings account that I have ever seen, currently sitting at 2.35%, which means that if you had a savings account with $10,000, you'd be generating $235 just in interest. And just for comparison, guys, Bank of America offers at most a 0.02% interest rate, and Chase offers a 0.01% interest rate, so basically nothing. At any rate, Ally just reported their quarterly earnings, which weren't so great, and as I'm sure you can imagine, it had a negative impact on their share price performance. Year to date, they are down 46.21%, and just in the last 30 days, they are down 18.5%, a lot of it from this bad earnings release, which came right about here, guys. The good thing is that this negative share price performance is creating a really great buying opportunity for Ally Financial, I think. The valuation is looking rock solid. As you guys can see, they have a forward PE ratio of 4.07, which truth be told is not something we really look at with bank stocks. We look more at the price to book, which is looking equally as impressive, 0.7. And to sweeten the deal, this price to book is about 41% lower than the sector median and is about 17% lower than the company's 5-year average price to book. And furthermore, if we take a deeper look at the book value of this company, we see that it's going up over time, which is fantastic. While at the same time, guys, the shares outstanding is coming down quite considerably. As you guys can see, they have a pretty high yield sitting at about 4.5%, with also a very nice 5-year growth rate, 26.15%. So you get the high yield and you get the high growth, and you have somewhat of a dividend growth history, 5 consecutive years. If they're able to keep up what they currently have going on with the high yield and the high growth, I think they're going to be a hard stock to beat. Now, those were the 3 main stocks that I wanted to cover for today, guys, but still there are quite a bit more stocks that I think you need to keep your eye on. The first of which is Scott's Miracle-Gro, which I think has seen one of the biggest drops of the year so far. They're down 73.5%, and just in the last month, guys, they're down another 17.3%. And to expand on this a little bit more, if we zoom out over the last 5 years, guys, the share price peaked at about $250 per share just back in April of 2021, really not too long ago, and since then, it's really, oh my god, it's just really come down. The next one is Simpson Manufacturing Company, ticker symbol SSD, which is also down quite a bit year to date. They're down 43%, and in the last month, guys, they're down another 6.5%. I gotta give a shout out real quick to my man Joel Batista. He's going by Fernando on here, maybe that's his stage name, but he wrote a really solid article on Simpson Manufacturing. If you guys want to read it, I highly recommend it. Next up, guys, I know, but I gotta mention 3M. They are just down so much. Year to date, they're down 36.4%, and in the last month, they're down a little bit more, 2.78%. And I know this is not everyone's favorite stock right now, guys, but a dividend king with over 60 years of consecutive dividend growth down this much, it's at least worth keeping your eye on. Next up is Williams-Sonoma, which is no secret at this point that this stock has gotten so cheap. They're down 32.5% for the year, and look at this substantial drop right here, guys. In the last month, they're down another 15%. Crazy. And as far as PE ratios goes, this is looking outstanding, guys. 6.95, nice low single-digit PE ratio. And next up, guys, this is another one where you're probably gonna roll your eyes, but keep an eye on Intel, okay? Year to date, they're down 51%, and in the last month, they're down another 10.5%. This stock just does not stop dropping, and like I said, I know some of you guys might roll your eyes, but let's see what happens with this bad boy. It just seems to be getting cheaper and cheaper over time. Next up is Stanley Black & Decker, which has seen an incredible loss this year. They're down 61%, and just in the last 30 days, they're down another 14.3%. 3%. And this is another one of those guys where it hasn't seemed to do anything besides go down in share price. It's definitely, as time goes on, becoming a better and better deal. Moving on, you got to keep your eye on Whirlpool, okay? They're down 43, almost 44% year to date. And in the last month, they're down an even 10%, so double digits. And look at that low PE ratio, 6.33. Moving on, guys, keep your eye on Qualcomm, ticker symbol QCOM, which I think is a pretty solid alternative to Intel if you want some semiconductor exposure but don't want the risk from Intel. Qualcomm is another decent one to look at, and year to date, they're down about 40%, with another drop in the last 30 days of 11.15%. The second to last stock here is one that's been cheap for quite a while now. It's T. Rowe Price, who was down about 50% year to date, and in the last month, they are down another 11.25%. And last but not least, this company is a compadre to T. Rowe Price, very similar companies in what they do. This is Franklin Resources, ticker symbol BEN, and year to date, they're down 35% with a drop of 11.4% in the last month, so another big drop. Anyway, now that you guys are clued in on some of the best dividend stock discounts to take advantage of right now, check out this next video right over here, where I tell you about 7 more stocks, all real estate investment trusts that have seen the biggest drops in 2022. These stocks are down 40, 50, 60% and are calling your name, so check them out right here, and I'll see you in the next one.